Thank you for joining me. I'm Alex, and I want to talk about Broadcom today. Broadcom is a company that everyone knows who ever had the pleasure of trying to look for network drivers on a Linux machine. So what they do is semiconductors like, network cards and a bunch of other stuff. Current price is $443, which gives them a market cap of $180 billion. Dividend yield is 3.38% with a payout ratio of 205%, which is obviously slightly high. Revenue $23.9 billion, earnings $3 billion, and their current PE is 69, which obviously doesn't help with the dividend yield of 3.38%. As you can see by the payout ratio, those things don't quite go together. Forward PE of 17 obviously makes it possible and fairly easy to have a dividend yield of 3.38% with a payout ratio of less than 100%, 80-ish, I think. No, I can't math. So either way, if they hit the forward PE, their payout ratio would be below 100%. Obviously, a PE of 20 with a dividend yield of 5% would be 100%, so that would be significantly lower than that. Total assets $75.9 billion, total liability is $52 billion, which gives them a total stockholders' equity of $23.9 billion. And obviously, balance sheet is quite nice, despite the fact that they're paying out over 100% of their profits in dividends. Beyond that, I can't really fault them for the decisions they're making there. I would appreciate a better balance sheet there, but it's not terrible by any means. So as far as risk factors go, there's obviously many technology companies out there working on similar products. So with technology advancing as fast as it is today, there's a chance for new competitors to come up with new things that will be the standard in a few years. Obviously that could happen for all the products that they make, but it's unlikely that they will just lose market advantage in everything that they do. So overall, I wouldn't say that there's many new risk factors here. Kind of just business as usual mostly. So obviously not really enough growth for a growth investor. For a dividend investor, 3% of dividend is quite nice, but the payout ratio is obviously unsustainable. I wouldn't assume that they lower their dividend just because it's over 100% payout ratio, because, as I said, the balance sheet is quite nice and they can definitely deal with that for a while. But it's not the safest thing to invest in a company with a payout ratio over 100% or even close to 100%. So if you think that this company is stable enough and will go back to growing or to higher growth, I guess, then it could very well be worth a closer look. For a value investor, the balance sheet is quite nice. The forward PE is pretty decent. The dividend is obviously nice. The only concerning thing is the payout ratio over 100%. So I would definitely look into this if you were a value investor and you wanted to diversify into, technology/hardware stocks. Definitely an interesting company to look into. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.